I have a lot of trade activity. I have that, that fat area of TPOs in here. And then here are my unfair highs. And here are my unfair lows. So these really are, you have little activity here as reflected in the TPO count. So these are, calling these low volume nodes, I call these areas key reference areas. This upper key reference area, lower key reference area, the high volume node is the key reference area. Now, this is key. This process occurs in all degrees of time and all markets all the time. So where do we want to be trading? At the extremes. We want to be trading at the extremes. These are things that you hear me say all the time. You hear me say this in the room. You hear me say it in, the trade lessons. You'll hear Troy talk about it. You want to be trading at the extremes. And these extremes are inflection points. And there are three primary inflection points in any given time frame. And in all time frames, these primary inflection points exist in all time frames. So what are these primary inflection points? What are they? They are the range extremes of a balance area and the high volume node of the balance area. And this is key. This is a key part of this phrase, in a mature structure. If you enter in the middle of a range that is only one or two swings deep, so to speak, it's pretty random. If you enter a trade in a mature structure near the high volume node, if you have some reason to do it, I don't just rote do it, but if you go down the smaller degree time frames and you see conviction on the bar chart moving away from a high volume node, those can be really good trades, especially in a mature structure. So here are the three primary inflection points where you want to be thinking about trading: your upper extreme, your lower extreme, and the high volume node. And this is sort of a schematic of the decision process. You're buying or selling here, you're buying or selling here. In a mature profile, you want to be a seller on the price side of the high volume node, you want to be a buyer above the price side of the high volume node, as long as you are near the structure. It becomes a more two-sided question the closer you get to the extreme. When you're trading here, guys, you know with certainty the market's going to trade to here or to here. The only edge you have when you're trading near this high volume node is to favor trades on the price side of it when you're on the price side of it. In other words, if I'm trading in here, in the absence of additional information, the only edge I have is to go long with a lean just below this high volume node. Now, if this is a structure that's a month long, like the NASDAQ, and I see the NASDAQ beginning to trade sharply lower, then you sell it down. You'll sell it anywhere as it gets to this area under the assumption it's going to continue initiatively lower, or you're buying it above here. John, you asked a great question. What is the definition of mature in this context? I can't give you a good definition, is the short answer. I can't give you a good one. Markets tend to have sort of a clock in a given trend. And it's after 3 or 4 days in a strong trend, you're looking for that market to break again. And that's just a general guideline. I can't. There is no good definition. And I'll tell you something else. There are ongoing attempts for someone to define that using different means. For instance, Stottlemyre. I listened to a webinar. As a matter of fact, I may make that an assignment. But I listened to a webinar that Stottlemyre gave the other day, and Stottlemyre has been on this chaotic search to program market profile. And he hasn't changed anything in about, 17 or 18 years. But he keeps rebranding it and calling it different things. And he's on this idea that if he can define the number of TPOs to a certain level, beyond that certain level, it is increasingly likely that that is a mature profile. So that's one way to do it in a rote manner. And it's a long story, but I studied his recent work several years ago. I had his software for a year. I leased his software, and I've had all his stuff and studied it. I couldn't find an edge over what we're doing. I don't think you can make this rote. Now, here's the good news, John. You don't have to know when it's going to break. At a certain point, there is an inherent edge trading in this area, whether it's a mature profile or not. That's the good news. You know you want to be trading in here. You know you want to be trading here. And you'll develop a sense for a given market as to what is a mature profile. 3 or 4 days in the stock market, for instance, tends to create tradable, balanced, and initiative situations, or condition for an initiative move. Yeah, Troy brings up a good point. It depends on the time frame you're trading. He's got a 1.5-year balance area in the British pound, which is a nice segue into where we're going and where we're going to end up. So here's a more detailed schematic of the decision, your trade decision. If I go long in this area, the market should not trade much back into this range. If it does, it's probably not initiative and I want out. Now, taking a short trade, which is a responsive trade in market profile parlance, I have a little bit more defined risk where it's more objective. If I go short anywhere in this area, the market should not trade more than 3 or 4 ticks outside the extreme at that point in this range. But this is an area to be considered that you want to be thinking about trading. This is an area you want to be thinking about trading. This is an area you want to be thinking about trading. The decision whether to go long or short can be fine-tuned depending on the market you're trading and what has preceded this. So it's not just a coin flip whether to go long or short. There is information about what you want to do that you will have as the market is trading into this area. If you're trading into this area with a lot of momentum and conviction, you probably don't want to be shorting it. If the larger degree trend of this market, if this is a 3 or 4 day balance area, and you've got a market that has been, on an intermediate term basis, the last month or two has been trading higher, then the probabilities, you probably want to go with, favoring the long side of the market. And that's something else that we'll talk about in other sessions, is the decision process of whether to go long or short and how to drill down into that process to increase the probabilities of taking the right side at these points. But for now, pat yourself on the back if you can learn to consistently trade at these levels. That's a win right now. So why do we want to trade in those areas? What's the reason for trading in those areas? Expect a sharp move. Simply put, John, that's it. Yeah, it's expectancy. You're expecting a sharp move. There's a greater than random probability of a sharp move. Remember, where we started with this thing, most price activity is random. There are only certain areas and certain times. Time is an important component. We haven't spent a whole lot of time talking about time, but we will. But there's only a certain time and area where you really have an edge in trading, and that's where you want to be trading. You don't want to get caught in the noise. Most traders are trading noise. They're fighting noise. They're guessing. So these areas are inflection points. There's an inherent edge, inherent, in consistently taking trades from these areas. You will teach yourself to trade if you will consistently trade in these areas. These are areas where we can most objectively and consistently determine risk and reward. These areas provide us an opportunity to develop a personal trade plan. And Troy and I look at the exact same things. I think you guys see over and over again. Troy will say something, and then I'll come in the room and type something, and he'll laugh because he's just said it in the room. We view the market very, very closely. We trade it a little bit differently, but we're looking and trading the same information. We're just taking that information and we're developing, our personality around it, what we're trying to accomplish, the account size, a ton of different things come into personalizing a trade plan. And this is another key point. Learning to do this enables you to achieve a positive expectancy without having to achieve perfect execution. That's something else everybody else out there is assuming they can do, and that's execute almost perfectly. Price-based traders don't stand a prayer, because if they're even risking 2 points to make risking 2 points to make 2 points. Now that might sound like a lot of latitude, but it's not. You have to be almost perfect to pull that off over time and have a positive return. You're trading noise when you're doing that stuff. This allows you a wide latitude of being able to be late, make mistakes, miss trades, bungle trades, all the things that you will always do, regardless of how long you trade. All of those, you're never going to get over those things. Hopefully, you don't do them as often after you've been trading 28 years as you did when you were trading 8 years, but you will still do them. So you've got to have a trade plan that gives you room where you don't have to be perfect every day, in and out. Now, I mentioned when we started tonight some of the things that you needed to avoid. And traders know, most traders know that they overtrade. They know they don't have any discipline. They know they don't have any patience. And they do all this deep psychological work that trying to uncover the subliminal reasons that they're undisciplined and patient. And the reason a lot of times, if not most of the time, is you can't be disciplined or patient unless you have a basis for it. If you're sitting there and every single day, you're trading a 1-minute bar chart in the S&P because your guru tells you you're not, there's less risk that way, you're trading noise. And if the market moves 3 handles, you think you're missing something. You have no basis for being disciplined or patient. So this gives you a reason, a basis for being disciplined and patient. If you have a basis for being disciplined and patient, it's a whole lot easier to be disciplined and patient. And the other thing, it provides definition and structure to the trade plan, to any trade plan. And there's more than one trade plan you can have with this. And also, I said if you would trade from these areas and you kept records, you would teach yourself to trade. This enables you to grow as a trader and to make use of your trade activity now, even if you're not achieving the results you want to achieve. Why? Because you're basing your trade decisions on a consistent, objective approach. And if you're attempting to do something for the same reason day after day, and you look at your trades, and then in the hindsight of the 2020 beautiful vision of 2020 hindsight, when the market's not trading, you go back and look at your charts, and you can see, was I trading in this area or not? Why did I lose money on this trade? And this way you can develop metrics that will measure and improve your performance. People don't record their trades, and they really should, but quite frankly, if you're a random trader, recording your trades isn't going to do any good because there's nothing consistent to measure. It's just a bunch of random loss here, win, win, loss, win, loss, win, but there's no rhyme or reason to any of the trades. So this gives you a definition and a structure, and if you will use that definition, attempt to use it, and if you'll keep records and develop metrics, you will teach yourself to trade. The other reason you want to learn to trade in these areas is because it's a concept that you can use to trade any market in any time frame. You don't have to just day trade the S&P Mini. You can trade your retirement account, whatever, stocks, options. Really, the world is your oyster using this methodology. This methodology is an extraordinarily deep, broad worldview of how markets develop and behave.